Welcome to the deep dive. Today we're digging into the strategy of a major furniture company. We've got a set of Q&A excerpts from their executives. And what we're trying to do is connect the dots on three big ideas that at first glance don't really seem to fit together. There's this huge pushback into U.S. manufacturing, a really strict philosophy on their profit margins, and then this promise of some kind of secret game-changing new product.
And the thing that immediately jumps out, the real hook here, is a total paradox. When you hear reshoring or made in the USA, you just automatically think higher costs.
Right.
That means the company eats the margin or, you pay more for the product.
That's always the assumption. But these sources, they lay out this incredibly audacious goal. They are re-engineering their entire system to hit a cost that is the same as, or maybe even lower than, what they were paying overseas before the 2018 tariffs.
Exactly. This isn't some patriotic vanity project. It's a cold, hard, strategic calculation. The mandate inside the company is to benchmark against their cheapest historical costs ever. And, they're very clear. This has taken years of what they call heavy engineering and a total re-engineering of product from a material standpoint.
Okay, so let's unpack that. This aggressive shift. The CEO says bringing manufacturing for their main business, their seats and sides, back to the U.S. is the thing he's most excited about. Yeah. Why so much excitement for something that sounds so incredibly difficult?
The main reason is mitigating volatility. They have just been hammered for a decade by chaotic global logistics. It all really came to a head after those 2018 tariffs.
Yeah.
And the risks they mentioned are, well, they're almost unbelievable. You're talking about everything from shipping container shortages to hurricanes, and they even mentioned pirates.
I have to stop you there. Pirates. Affecting sofa production. That really just says everything about how crazy the global supply chain has gotten.
It does. And for a company doing, better than $600 million a year in just that one product line, the financial risk is just too big. So they've decided to quit what one of them called the hopscotch game around the globe. They're now, and this is a quote, completely out of China and want to be closer to their customer. Shorter shipping means more efficiency and, it has real sustainability benefits too.
But that kind of move for a huge product line, that has to require an immense amount of capital. The only way that pays for itself is with massive scale and automation. That must be the heavy engineering part.
Precisely. That's where their scale becomes the advantage. That 600 million plus number justifies the investment in, very advanced automated manufacturing here at home. It's not about finding cheap labor in the U.S. It's about engineering the labor component out of the process so you can compete with those old offshore costs. That is the challenge they've taken on.
All right, let's get into the financial calculus, because that's where, most people would get skeptical. How can this possibly make financial sense, at least in the short term? The goal is parity with their lowest cost ever.
And they admit that mandate to meet or beat the Sactional's cost on an apples-to-apples basis pre-tariff is, well, it's incredibly difficult. They aren't promising it's already done. But just striving for that goal shows you how bold the project is. And if they pull it off, the long-term benefit is huge. They mentioned more stable pricing. They're insulating themselves from whatever happens in the Suez Canal or, anywhere else.
But hold on, aren't they just trading one kind of risk for another? Swapping global logistics risk for, say, domestic political or regulatory risk?
That's a fair point. But the sources point to a much bigger, more immediate win that seems to outweigh that. And that's inventory. Manufacturing onshore, they say, mitigates tremendously the massive cost of warehousing and just carrying all that inventory.
And this is the hidden savings that really jumped out at me from the transcripts. The amount of money they have tied up is just staggering. At the time of this Q&A, the CEO said they had probably 400 containers of Sactionals or what have you just out there. In progress, on a ship, or sitting in a warehouse.
400 containers. Just think about that. If you even just guess, say, $100,000 a product per container, you're looking at $40 million.
Wow.
In working capital.
Right.
Just sitting there. And that's not even counting insurance, port fees, warehousing. It's what they called a ridiculous amount of product.
So the math starts to make sense. High upfront investment in engineering and automation. But you offset it with stable shipping costs and this massive relief from not having to carry all that inventory. And that's enough to make the whole project work.
That's the plan. They expect it to have a positive impact on our P&L in the long term. They're basically trading a volatile, ongoing cost for a fixed, controlled, and automated one.
Okay, but then there's this unexpected twist. It seems that being forced to re-engineer everything for cost, it didn't just lead to efficiency, it led to some kind of major product innovation.
This is where it gets really interesting and really competitive because they had to rethink the entire product from the ground up, the frame, the materials, everything, to make it work with the new automated lines.
Huh?
They accidentally made it better. And they're quick to say, this is not hyperbole. The new US-made version will be a better product made in a more robust way.
A better product is great, but the language they use to describe the new features, I mean, for a sofa, it's almost hard to believe. The CEO claims the new sectionals will have features that are completely groundbreaking in the world of sofa sectionals.
Yeah.
He says they are one of one, and that they solve problems that no one in this industry has ever solved or even conceived of solving.
That kind of hype, it suggests it's not just a little stronger. They must have solved some core frustration that we all just, accept as part of owning a couch. If you think about their brand modularity, durability, cleanability, what's the next big problem to solve? Is it the weight, making it easier to move? Or maybe it's something about integrating tech in a way that's actually, useful and protected. It has to be something fundamental.
Whatever it is, they're turning this entire reshoring project into a huge competitive advantage. They expect this to make them way more competitive, and it's already leading to new patent work. So a defensive supply chain move, it actually became an offensive R&D project that's creating proprietary tech.
It creates a moat,
Yeah.
a real one. They're turning an operational headache into a commercial weapon. Which brings us perfectly to the last piece of the puzzle, how they plan to price and protect this whole thing.
Right. So if you've got cost parity and a unique patented product, the next logical question is, how do you price it? And that brings us to their very disciplined approach to gross margin.
Their entire financial model is built around a really specific number. They target the high 50s for gross margins. So think between 55 and 60%, which, by the way, is at the absolute high end for their industry, its position of strength. But the really interesting part is that they also have a ceiling.
Yeah, the guardrail strategy, as you called it. They are deliberately choosing not to push margins much higher than 60%. Why would you do that? Why leave money on the table when you have a new, unique product that could probably command it?
It's a classic long-term strategic move. The sources say pushing it higher just isn't prudent. They feel that if the margins get too rich, it leaves the business, quote, further open to competition, copycats. They're basically saying we're leaving too much meat on that bone on purpose.
So they're intentionally capping their own profitability to make the market less attractive for anyone else to even try to compete. It's offensive pricing. They're prioritizing stable market share over a short-term profit grab.
Precisely. It's a clear signal to the market. We are very profitable, but we're not greedy, and we can and will undercut any potential rival. Good luck trying to compete with a 55% margin when you don't have our scale or our patents.
And we see this exact same thinking carry over into their big expansion plans, right? That move into the new room product category. That's a time when most companies would, accept lower margins just to get a foothold.
But they're not going to. The COO, Mary Fox, she confirms they plan to maintain the gross margins from day one. There's no plan to promote heavily initially or anything like that. They want this new category to be just as profitable as the core business right out of the gate.
So the whole strategy for the next year is just incredibly controlled. Solidify the core business, finish this massive reshoring project, protect that high-end margin at all costs.
That's it. To lean into the core business, becoming the most prolific advertiser of couches on the planet, and just harvest value from it, especially in a choppy environment. They're doing all of that before the full launch of the new room products. They're building the strongest possible foundation first.
So let's bring it all together. What does this mean for you, the listener? We've just walked through a textbook case of a strategy that's both defensive and offensive at the same time. It's defensive in that it protects their supply chain from global chaos. But it's offensive because that same move is creating huge patentable innovation and protecting their elite profitability.
It's a fantastic blueprint, really. You see how external pressure tariffs, shipping forced an internal innovation. And that innovation, born out of necessity, led to a better product, more efficiency, and a much stronger competitive position. They literally turned a crisis into a long-term advantage.
And so we end where we started, with those claims about a groundbreaking feature. Remember, this isn't just a new fabric. This is about solving a problem that no one has ever solved or even conceived of solving.
And that's the knowledge gap we're left with to think about. We know this brand is all about modularity, durability, customization. If you're going to file new patents on a sofa, you have to be addressing a universal pain point. Is it the cushions that always slump, the nightmare of trying to clean it properly, or is it something that changes how a couch even functions in a room?
So the provocative thought we want to leave you with is this. Given all the hype and all the talk about new IP, what fundamental problem could be solved that would turn a simple sofa from a piece of furniture into a genuine piece of 21st century technology?